From the person who stuffs cash under their mattress to the one betting it all on the next big thing, the investing world is just full of different characters. So let's break down every major type of investor. By the end of this, you'll have a much better idea of where you fit and maybe which strategies you should, probably stay away from. So let's just kick things off with a quick gut check. The market suddenly drops 5%. What's your immediate reaction? Do you feel that knot in your stomach and think about selling everything? Do you maybe see it as a sale and get ready to buy? Or did you not even notice it happened? Seriously, your answer to that one question tells us a whole lot about the kind of investor you might be. All right, we're going to break this down into four main groups. First up, we've got the classic stock pickers, who we'll call the core strategists. Then we'll get into the big picture thinkers, the system builders. After that, we'll take a quick, and I mean quick, detour into the wild world of market timers, and we'll wrap it all up with the alternative path, for folks who look way beyond Wall Street. Okay, let's dive right in with the core strategists. Now, these are the investors who believe that the real secret to building wealth is finding and holding on to great businesses for the long haul. They're not just buying a stock ticker, they're buying a little piece of an actual company. You know who's totally chill during a market crash? This person, the value investor. Think Warren Buffett. They completely ignore the day-to-day noise and instead hunt for bargains. They do the math to figure out what a company is actually worth, and then they wait and only buy when the stock price is way, way below that number. That gap, that's their margin of safety. It's their cushion if they get it wrong. And their time horizon, pretty much forever. And then, on the complete other side of the spectrum, you've got the growth investor. These guys are always chasing the next big thing. The disruptors, the innovators, companies whose revenues are just exploding. Honestly, they don't really care if a stock looks expensive right now. They're betting that its value is going to multiply over the next 5-10 years. And here you can really see the difference in their DNA. The value investor's whole mantra is buy great companies for cheap. They're focused on today's real value. The growth investor, they believe the biggest returns come from the fastest growers, and they're focused entirely on that future potential. It's the difference between Buffett and, say, someone who got into Tesla really, really early. But hey, what if you're a little bit of both? Well, that's where the GARP investor comes in. GARP, it just stands for growth at a reasonable price. They're looking for those innovative growing companies, but, and this is the key, they refuse to pay a crazy price for them. It's kind of a perfect middle ground approach. Not too boring, not too speculative. And last in this group, we have the dividend investor. These investors are laser-focused on one thing: cash flow. They buy stable, solid companies that pay out their profits to shareholders. Those are the dividends. They're literally building a portfolio that pays them to own it. And think about this. A $500,000 portfolio that yields just 4%, that's an extra 20 grand in your pocket every single year for doing nothing. Pretty cool, right? All right, let's move on to our next group, the system builders. These investors, they're not necessarily trying to find the one perfect company. Instead, they stick to a broader system, a philosophy that guides every single one of their decisions. And who better to kick off this idea than Warren Buffett himself? His advice for most people is just dead simple: consistently buy a low-cost index fund. That's it. This right here is the foundation for our next investor type. So meet the index fund investor. This is the ultimate set it and forget it approach. See, they aren't trying to beat the market, they're just trying to be the market. They buy funds that own a little bit of everything, they automate their investments, and then they pretty much just ignore all the day-to-day drama. It might be the most boring strategy out there, but as Buffett proved in that famous bet he made against hedge funds, man, does it work. Now, let's talk about someone who does the exact opposite of what everyone else is doing, the contrarian. They live and breathe this famous Buffett quote: when everyone else is panicking and selling, they're buying with both hands. When the party's raging and everyone's euphoric, they're quietly cashing out. The classic example, Michael Burry. He saw the 2008 housing bubble for what it was and bet against the entire system while everyone else was telling him he was nuts. Then you've got the quants. These are the folks who try to take human emotion completely out of the equation and just let math run the show. They build these super complex algorithms that scan millions of data points, prices, news, everything, to find some kind of statistical edge. Then they just let the computers place the trades automatically. For giant firms, it can be incredibly powerful, but for the average person, it's pretty much impossible to do this yourself. Okay, quick timeout. We need to put up a big warning sign here. We are officially leaving the world of investing, and we're about to step into speculator territory. The next few types, well, they treat the market less like a savings account and a lot more like a casino. Which brings us to the market timers. Their entire game is trying to predict where the market's going to go in the very near future. It is incredibly high risk, and to be frank, it's where most people end up losing a ton of money. So in this world, you've got the momentum trader who just jumps on whatever stock is already shooting up, hoping that trend continues. You've got the day trader who's glued to their screens, making dozens of trades a day, trying to scalp tiny profits. And then you have the options trader, using some pretty complex financial tools to make these massive leveraged bets that can either pay off big time or completely wipe them out. All right, for our last section, let's step off the Wall Street roller coaster completely and look at investors who forge a totally different path. And there are some really interesting ideas here. You have real estate investors who use the bank's money to buy an asset that their tenants then pay off for them. There are crypto investors swinging for the fences, hoping for those 100x returns in what's still a total Wild West. You've got ESG investors who try to make sure their portfolio matches their personal values. And then there are angel investors who put money into tiny startups, hoping just one big winner will pay for all the ones that go bust. Oh, and we can't forget the gold bug. The person who only trusts physical gold as real money. But being too defensive has its own risks. I mean, look at this. Between 1980 and 1999, gold actually lost more than half its value. And during that exact same time, the US stock market went up over 1,000%. That is a massive, massive opportunity cost. So after going through all these different personalities, from the super patient analyst to the outright gambler, we get to what is probably the most important point of all. The real secret to success isn't hidden in some complex chart. It's about understanding yourself, your personality, your goals, and what you can actually handle when things get scary. So I'll ask you again, now that you've met all the players, which one are you? Are you a patient value hunter? A forward-looking growth chaser? A disciplined system builder? Because the best strategy in the world isn't a secret formula. It's just the one that fits you so perfectly that you can actually stick with it through good times and bad. And figuring that out, well, that's the real key.